right now because he knows better than I do. So, but it's a little crazy.
Yeah.
So
Yeah.
some of the things we want you guys to take away from this today are, there's a lot of benefits to owning a home. I rented in the past, Zach's rented in the past. You write that rent check, you give it to the landlord, and then you never see it again. But there's also a lot of things you need to know going into it, and that's what we're going to try and fill you in on today. A little bit different loan programs, kind of the purchase process a little bit. We don't want to get too into the weeds. We can do that one-on-one. What it takes to find the right home, how we evaluate homes and the offer process, and then finally, getting it wrapped up to close and getting everything done. One of the main things we do talk about is the financial aspects of buying a home and how you're building equity in something. Your house is typically the biggest asset you're ever going to have. And it's something that you can pull equity out of in the future if you ever need anything. The difference is rents in the area run anywhere around like $900 a month right now, and it typically will go up, about 5% a year. So after 5 years, you've spent about $55,000 in rent. You have no equity. Like I said, you write that check, give it to your landlord, you never see it again. That's just money that's gone. You get no cost-effective money in that situation. For comparison, if we did a $900 mortgage at 4%, and nobody's really getting a 4% mortgage right now, either they're all lower than that, you can buy a home up to $190,000. In those same 5 years, you're going to be having an appreciation of, homes are going up typically 2% a year. Right now, it's a little bit different, but typically they go up. But if you bought a house right now, chances are it's going to increase in value even faster than that 2% over the next 6 months, a year to 2 or 3 years. We don't know. There's a shortage of housing, as everyone kind of is aware of, and Zach can talk more about that at the end. But you would earn over $15,600 in equity in like the worst case environment. So automatically you're coming out ahead. The biggest part of home ownership is home equity. And the nice thing about having it is you have the ability to tap into this equity. I share this story all the time. Last year on New Year's Eve, my well pump and my furnace went out within 24 hours of each other. And it was like the coldest day of the year. And, I was able to tap into my home equity, replace the furnace and stuff, because I don't have that kind of money just sitting in my checking account. And, the person came out, fixed everything, brand new furnace. It offers you financial flexibility that you otherwise wouldn't have. So question for everybody here. What do you think comes first? Is it finding the home, going out and shopping, talking to a realtor, or talking to your credit union about getting pre-approved? Anybody have any answers? We want to step into the water here and try it out? I'm getting some C's. That's going to be correct. The reason why is there's not a whole lot that we can do without, Zach can't go find you a home unless Zach knows what you can afford. We don't have the ability to do that. In the worst case scenario is you go out and start looking at stuff, you fall in love with something that either you may not qualify for, or you qualify for something much nicer and you're selling yourself short. I know when I went out to buy my first house, I had in my head what I was going to spend. This is what it was going to cost. And I was just fixed with like this number, and the number didn't equate to what I ended up buying. I bought a nicer house than what I had in my head. So talking to your credit union, getting pre-approved, letting us take a look at stuff, that's the way to get started. So we're not going into this whole thing blind, or you're not getting too far ahead on one side of the steps, and then we need to back all the way up to the beginning to start all over again. So pre-qualification, Saturday morning. This is the first step in the process. We're going to find out information about, where you're living, where you're working right now, how much you make, how much you got saved up, what your plans are, what are we trying to accomplish. We'll take a look at your credit. Now, this does result in a hard credit hit, but I want to be honest with everybody here. Getting your credit pulled does not destroy your credit score. I've been pulling credit since 2006 when I started selling cars out of college. It doesn't really hurt. The impact on your credit score is going to be a point, maybe two. And if that's the difference between you getting a house and not getting a house, we have other things we need to address first. So what I suggest you do, have somebody look at your credit, somebody that's been doing this a while that can, even coach you. Say you're not buying now, but maybe in 3, 4, 5, 6 months you are. Talking to somebody like me or somebody else at Arbor, we can give you advice on how to either get that score up if you're not up high enough already, or just, the difference between a 700 credit score and a 720 is usually about 1/8% in the interest you're going to pay on a house. And it's just typically little things that we can do to help you there. So getting the credit ran isn't the biggest deal in the world. Just don't go to like a car dealership and then go to Best Buy and then go to Home Depot and get a car loan, a credit card, and don't do that, and you'll be fine. Having somebody take a look at your credit does not totally grenade your credit score. After we have all this information, that's when, I'll start requesting stuff from you. This will be W-2s, check stubs, things like that. We'll get to that in the next slide. But this allows me to get a pre-approval letter out to Zac or to another realtor of your choice to get you out there looking at houses. That means I've got the documentation now. You've told me what you make. Now I have the proof of it. We're good to go. If you want to start the process, you can go to arborfcu.org. Now at the end of this, I will probably just offer to send you guys some links to my direct portal, so stick with the same person, but we can cross that bridge when we get to it at the very end. After that though, I send you a letter and tell you to go find a house, and good luck. The perks of getting pre-qualified is you know what you can afford before you shop. Most realtors aren't even going to rent it. Zac will talk about this, but Zac, do you want to share this? Will you even show people houses right now without a pre-qualification?
So generally speaking, if you don't have a pre-qualification or a pre-approval letter, you're going to either be forced to go through only open houses, or if there are sellers that are willing to let you through, you might find one or two houses. But especially after the pandemic that we went through, a lot of sellers realized that they want to double check that they're only showing their house to qualified or pre-approved buyers before they even open the house up, because they just don't want to take the time out of their busy schedule and their busy life for somebody that's not even ready to buy a house or isn't ready to put an offer in. And on top of that, if you're walking through a house and you're not pre-approved and you're not ready to make an offer, there in this market right now, there's probably going to be 2 or 3 other people that have already put an offer in. So you're really just going out and looking at nothing because it's going to be gone by the time that you're able to get approved. And that's why it's so important to do this first.
Yeah.
Mm-hmm.
There you go from the guy. It's too
yeah
right now, really, to be out looking without having one.
Mm-hmm.
You want to be ready to go in. You want to know what you can go up to, what the budget's going to look like, and that's all stuff that we can handle before you even write an offer. It's pretty easy for us to do it once we have those first ducks in a row at the beginning. That's a good question. So how long is your pre-approval good for? Now I write my pre-approval letters, and we have a sample of it right here. I just put it up. Mine are listed as good for, I believe, 45 days. They go longer. The main reason we put that timeline on them is simply because interest rates can change. And the other reason is your credit report's only good for 120. So if I pulled your credit today, it would be good until approximately November 25th. Now, if you go out and buy a house next week with my pre-approval letter, you're fine. But if we wait until, towards the end of October and you're still looking, we run the issue of your credit report might expire before you write the offer. So they're good for 45 days on the letter. All you do is call me, I'll write you a new one. If I need to update something at that point, I'll let you know. But typically, that's the main reason. Does that answer your question? Okay. So here is a sample pre-approval letter from me. In this case, we don't have a property address. Purchase price $200,000. This is a conventional one. It's for John and Jane Smith. These are fake people. I mean, I'm sure we have one at the credit union, but this isn't real. 5% down. Please allow 45 days to close. We can close loans faster. Zac and I just did one significantly quicker than that. But the main reason why is appraisers are also backed up, so we're kind of at their mercy, and we'll get to the appraisal towards the end of this presentation. But they need to go out and look at the house, and sometimes it can take them a week or two to get there, which can in fact, slow down the whole process. That's the main reason why. And then, verification of all the stuff that we talked about. Here's what I need to actually do the whole loan. I'll need 1 month of pay stubs, last 2 years of W-2s. If you're self-employed, I need 2 years of tax returns for both you and the business. If you're like an S Corp or an LLC, I'll need the business and your personal tax returns. If you're, just the sole proprietorship, a DBA, I just need your personals. Bank statements so we can document where the down payment's coming from, 401k and investment if it's coming from there. And then just a valid ID. And that's basically all we need. It's not that much different than if you were to get a car loan, other than, we want 2 years W-2s, we want some tax returns perhaps, and we just need to source your down payment. The main reason for that is for anti-money laundering. It's a federal law type reason. It's not really that we care where all your money is. I don't. Some of the loan products we offer, and this is where Arbor is actually pretty fantastic. We've got a bunch of different products. We have the ability to portfolio loans, which means that Arbor will actually like do a specialty mortgage in certain situations if we need to. And then we have some loans that, are just special to the credit union itself. So the standard, we've got, 30 years all the way down to 7 years. Those are all fixed rate mortgages, very standard, nothing fancy about them. But then we have a no money down, no PMI loan. Those are available in 30, 15, 10, and 7-year terms. The longer the term you go, the higher the credit score required to get one of those becomes. And the one thing about those I'll say is the interest rate is not going to be amazing on them, because whenever we're lending money, the credit union's assuming risk. So when we're assuming more risk, the rate goes up a little bit. Now they're still low. I bought my first house at 6.875%. So I don't really like to hear people complain about rates a ton. Rates are down. So even that rate's way lower than 6.875%. We have what's called a piggyback if you want to avoid mortgage insurance, which I'll touch on in just a moment. We can do like an 80-15-5 and an 80-10-10. Mortgage insurance, there's a separate slide dedicated to it, but what this does is it allows you to avoid it. You'll have a first mortgage for 80% of the purchase price. The second mortgage will be for either 10 or 15, and then you'll bring the 5 or the 10% down. I do a lot of these. Jumbos, if any of you guys are big shooters, anything over 5,000, 500, 400, 5,000, 48, $250, $548,250, can't talk, is going to be a jumbo loan. That's just a Freddie Mac and federal law guideline for the area. We do doctor mortgages if there's any of you in here. Rental loans, you guys are first-time home buyers, so we're not going to be looking at a lot of these, but these are for if you want to fix up the house. And finally, we have a construction loan here at Arbor. You can't build the house yourself, though, unfortunately. So what is mortgage insurance? The typical way, how many of you have cars? I'm sure everyone's got a car. When you bought a car, did you get a loan, and did you have gap insurance on it? Because that's the easiest way to describe what mortgage insurance is. Basically, as a mortgage lender, we are insured up to 80% of the home's value as long as we follow federal guidelines writing the mortgage. So we're insured up to 80%. Now, if you only bring 5%, then there's a chance that there's 15% of that purchase price that we're not insured for. And one thing that banks and credit unions don't like to do is lose money. So what private mortgage insurance is it's a policy that you'll go and purchase if you put less down. And what that does is, say you defaulted on the house, we can take that policy, then cash it in to get the difference. So it's like gap insurance for your house is the easiest way to describe it. And it just protects the credit union. Every lender is going to charge it. And we even have some options to avoid it, whether it's the piggyback loan or our no PMI 0% down loan. Ways to avoid it, oh, it's right there. So many questions that people first ask is my credit score just right? Is my debt to income ratio balanced? Do I need a certain amount in my savings? Is the length of my job considered in the process? And yes to all these, we can cover them real quick. Is there a magical credit score? Not really. We need a 620 minimum score to do the loan. So if that's the magic number, that's the one we'll go with. We pull all 3 credit bureaus from TransUnion, Experian, and Equifax, and then we just take the middle score, and that's what we use to qualify you. The 740 credit score gets you the 30-year, no money down, 100% financing with us. Increasing your credit score can be done a lot of different ways. What you'll want to do is talk to me, fill out an application. If we need to do some work on it, I'm more than happy to help you with it. I've raised credit scores up to 100 points in 60 days before. It just depends on your situation and what we can do to help you out. But I've pulled a lot of credit. I've helped a lot of people raise their score. So next is, what is a good debt to income ratio? And the answer to that is going to be, we use Freddie Mac guidelines. Typically it's 45%. So what you will do in that situation is take all of the debts that you currently pay monthly, and that's debts that would list on your credit report. So credit cards, loans, things like that are showing on your credit report. You'll take your gross monthly income and divide the total of that number by it. And we want to see that below 45% once we add the house in. It's pretty complex to do it first, but it's basically just, if I make $5,000 a month and my total outgoing debt is $2,500, my debt to income is at 50%. Does that make sense? How long should I show consistent work history when applying for the mortgage? We need to see 2 years of consistent work history. Now, there are some caveats. If you are a full-time student just graduating high school or just graduating college, we can get around it. We just need your tax transfer, or your student transcripts, I should say, showing that you just got done with school and then you started your full-time job. Yeah, don't change your job during the purchase, please. This has happened a few times in my 6 years of doing this. It's not enjoyable. Stick with where you're at. If you get raises and stuff, that's fine. If there's internal promotions, feel free to go for those, but don't change your employer because it will delay everything, possibly even prevent you from getting the house. The next thing though, when it comes to actually buying a house, and Zach can probably talk about this too, is people usually qualify for way more than they want to spend. Is that right?
Oh yeah, usually it's like double. They qualify for double what they want to spend, I would say. Yeah.
So what you'll want to do, and this is like where that pre-approval thing comes into help, because we can show you what the taxes will look like, what your insurance will look like, what your rate's going to look like. So then you'll have an idea of your payment. So you may qualify for a $300,000 house, but you don't want a $300,000 payment. And that's where your budget comes in personally. People don't realize that like 45% debt to income is actually quite a bit when you figure that, your taxes come out of that and stuff like that, that we're not accounting for. So these are all things to plan. And so that's why the pre-approval allows you to not like go into something blind and not know what you're signing up for when you write that offer. Because once you write that offer, and we'll get to the documents you sign here in a minute, you're committed. Some of the down payment products we offer, the no money down, 3, 5, or 20%. You can do 10, 15. Realistically, for down payment, you can put whatever you want. This is where mortgage insurance breaks stuff out. This is also where our interest rates changes in 5% increments though. The other thing to talk about is you will need to have money to pay for your closing costs and your prepaids when you close at the loan. So not only will you need the down payment, but you will need that. I will go into that more in depth if we have questions about closing costs after we're done. It's kind of an in the weeds conversation, but it's also kind of more of a one-on-one, but I will go over closing costs. And if you want afterwards, we can set up a time. I'll break everything down for you so you know exactly how it goes every single time. Gift funds. You can get a gift. You can get a gift to pay for closing costs, points, prepaids, your down payment. They are allowed. They need to come from a relative though, or somebody with a vested interest in you, relative, guardian, things like that. In order to document a gift, we have them sign what's called a gift letter. It basically just says, I, Rob, gift Zach $13,000 for the purchase of his new house. I do not expect him to pay me back. He does not have to pay me back. And then I sign it. I get a copy of the check and a statement from my account showing that money coming out. And that is what we need. There is no maximum on gifts, although a taxable situation for the person giving the gift does happen if they go over. I believe it is $15,000 for this year.
I think that sounds about right. It should be right around 50. If you just Google IRS tax gift laws, it'll show up with exactly how much you can get without it being taxed. And that's from one taxpayer to another taxpayer. So if you have a grandma and a grandpa, they could technically, theoretically, both gift you $15,000 without it hitting the IRS. But if you have very specific questions about that, I would contact a CPA.
Yes, not a professional.
Yeah,
some of it.
Yeah.
So finally, it's about to be turned over to Zach here, but one of the things that we see a lot of with people that are first-time home buyers is they don't really realize how the process works and how realtors actually make their money. And if you're buying a house, you want a realtor, especially if you're buying a house for the very first time. The reason why is they're going to protect you throughout the process, make sure that you are legally covered. Because like I said, real estate transactions are binding when you write these offers. There is financial risk when you write these offers. They know the community. They know what houses are going for. I like working with Zach because Zach is very good at writing competitive offers and getting people in houses. There's people that are realtors on the side. We all know these people that do 2 or 3 houses a year, and they basically just help friends and family, and they don't do it every single day. And that's what you want, is you want a professional that's been doing it and is out hitting the streets every day, looking at the market, knowing what's going on. They also guide you through each step. They can educate you on the costs that are going to be occurred throughout the process. And when it comes to negotiating stuff, when you run into issues, because we've been doing this a long time, you don't have perfect transactions. They never occur. There's always going to be something that comes up. This is the biggest purchase of your life. It's always stressful. Something's going to come up, and you want to have professionals that know what they're doing to get you through it. So with that, Zach, we'll go through some of the stuff that you do. So take it away, and I'll start clicking through your stuff. We'll get this one up first.
Oh, sure. So I guess to kind of go over and to touch on what Rob's talked about a little bit, the reason that a lot of people love buying houses is the equity. Rob touched on it briefly. I just wanted to put my 2 cents on it because I've been helping a lot of people that were first-time home buyers 3 or 4 years ago that were buying homes, around the 100,000 point, and now they're selling them for almost 200,000. I've got a lot of people that I'm personally helping sell the home that I first sold them 5 or 6 years ago, and they're moving up and they're getting, very large equity checks from their house. And it's just a really good way for you to be able to use the money that you're making at your job to better yourself financially in the future. So that's just my 2 cents on equity. This first document is what's known as an agency disclosure. In the state of Michigan, there's 3 different types of agency. Does anybody know what they are before I go through them? Or can you take a guess at them? Or are we all asleep because it's still only 10:28 on a Saturday? Because I completely understand that. So there's 3 types. The first one is a seller's agent. And that is somebody that's working for the seller to try and get the seller as much money as possible. When you go around town and you look at the signs and you see like, oh, hey, there's this sign for sale. I wonder who's doing it. The person that has their name on the sign is generally working for the seller, and they're trying to get the seller as much money as possible. When you do not have the next document, which is a buyer agency agreement signed, legally in Michigan, you're supposed to be working for the seller. So if you don't have a buyer agent representing you, you're supposed to be working for the seller. And that's what this is it just allows somebody to work on your behalf and to do all the things that Rob talked about, negotiating for you, guiding you through the process and helping with that. The second form of agency is a transaction coordinator. So if you have a family house or you have something that you want, a lower commission rate on, and you already have the house picked out between family members, there's transaction coordinators, which basically they just, in that position, the agent would just guide both you and the seller through the house. They'd turn the documents in, they'd get everything to and from the title agencies and the lenders just to make sure it's a smoother process. And then the third is, of course, buyer agency, where you're working specifically for a buyer to make sure that they're getting the best deal possible. And that's what this document is it's just a buyer agency agreement, and it allows somebody to work on your behalf to help you find the best house possible. I think the next one's the buy-sell agreement. Yeah. And so the buy-sell agreement, whenever you make an offer on a property, it has to be a written offer. Verbal offers are not allowed in the state of Michigan. If somebody says, yeah, I promise I'll sell you this for $100,000, and you don't have anything signed, there's nothing binding them to sell it to you. As soon as there's a written agreement, it's binding. And the buy-sell agreement, it's really an easy form. And I would say the 2 biggest takeaways that I would want first-time home buyers to know about this is that you have a 10-day home inspection period. So when you purchase your first home, you're not immediately bound to buy it, and you're not going to be forced to buy it if the home inspection's bad. Now, the home inspection is something that you would pay out of pocket for. It's usually about $350 to $400. You'd have a professional inspector go through, and they make sure that the house is up to the standard that you thought it was when you purchased it. And if it's not up to the standard that you expected, you're allowed to either back out of the house, you're allowed to ask for repairs from the seller, or you're allowed to keep going with the sale. So it's not as scary as I think sometimes people make it out to be. As soon as you put an offer in, it's not going to be, well, if I don't buy this house, I'm going to lose all my money, or the seller's going to force me to buy it. There is a little bit of a wiggle room period when you do put the offer in. The second thing that most people, I think, are confused about or don't know 100% about is that there's earnest money. And I think that's the next slide, if I'm not mistaken, Rob. And earnest money is just a good faith deposit that allows you to lock the house down. I was wrong. It was the buyer agency addendum. And what this does is, as Rob mentioned, 9 times out of 10, the seller is going to cover your buyer agent's commission. So if somebody lists a house, what they do is they list the house for sale for a certain percentage, and that percentage is split between a seller's agent and a buyer's agent. So that way, when you're going to the table, you're allowed to have somebody work for you for almost free, and they're able to get paid from the seller because of the split commission. And what this agency addendum does is it just locks down that the seller is going to be paying for the cost associated with your buyer agent. And back to the earnest money, it's a good faith deposit. It's typically about 1% of the purchase price of the home. And you take that money and you put it into an escrow account. So it's a non-interest bearing account that's usually at a title company or a real estate agency brokerage. And they make sure that the seller doesn't have access to it and you don't have access to it. So that way the deal keeps going smooth. The anti-fraud disclosure is just there to make sure that you know that, sorry, this is a different one than I normally use. So I'm just trying to read through it to make sure that I'm giving you the best information on it. This is just making sure that you know not to, wire money and do things with people that are not actually working with you. Each house that you walk through is going to have a seller's disclosure and a lead-based paint disclosure. This is filled out by the seller when they list the house, and it gives you the best representation of what the seller knows about the property. Regardless of what's on these disclosures, I always recommend that you make sure to get a home inspection. The best example I can give is the seller could put on here that the roof was done in 2020, and you could see it and it could look really good, but Jim and Joe from down the street put the roof on and they forgot to put wrapping around all the pipes coming out of the roof. And so there's actually leaks all throughout the roof, even though it's a brand new 2020 roof. And a home inspector is going to catch anything, even if the seller's disclosure says that it's good, anything that could potentially be bad. But it's just a good way to kind of understand where the seller's coming from. If you are potentially looking into purchasing an estate property or something where the seller is not really the seller, where it's somebody that inherited the property, these may not be filled out completely. And a lot of times they're very vague, and usually it's more, yes, all of these things work. There haven't been any leaks in the basement. We don't know when the roof was put in. And that was mostly because in 2008 to 2010, there was a lot of foreclosed houses and the banks didn't have to disclose a lot of what they knew about the house. So you may not find that the seller's disclosures are always as filled out as you want them to be. And again, that's why getting home inspection is one of the most important things. The lead-based paint disclosure is just saying or notifying you of anything that the seller could potentially see or has a report on regarding lead-based paint. Most of the time, these are no knowledge of lead-based paint and they have no reports pertaining to lead-based paint. And that's just because a lot of times the paint's been covered up, and typically speaking, if you ask a builder or a contractor, as soon as the lead paint is painted over, it's not dangerous anymore. And that's completely up to your discretion if you want to get a lead-based paint inspection, but most of the time you're not going to see anything that's concerning regarding lead-based paint.
Yeah, and to kind of go over something that Zach touched on too is one of the things that the reason why it's important to work with realtors and to work with lenders that you know and trust is, like he was talking about, like the home inspections and stuff and like the anti-fraud thing. There's really only 3 times in the whole transaction you're going to be asked to spend any money. And the first one is going to be when you write your earnest money deposit check, if your offer is accepted. The next one will be when you get to your home inspection within 10 days of that sales contract. And then the third one will be the appraisal after the home has been inspected. It turns out that it inspected pretty well, or there's a couple of small things, but you're going to buy the house anyway. Then we order the appraisal. Any other time somebody asks you for money in this process, don't spend it. Call one of us. We'll tell you what to do. because those are the only 3 times from when you start the home buying process to when you close and are at the closing desk buying your house that you should spend money. The only 3 times it ever happens. Any other time, don't do it unless you talk to one of us first.
Including after. And Justin, yes, earnest money is required. In order to have a legally binding contract in Michigan, you are required to give a good faith deposit in order to lock the house down, but it does count towards your down payment or closing costs when you go to close. And there's a lot of protection for the buyer regarding earnest money in the buy-sell agreement. So if the house appraises for, the seller does not state the required amount, you would be putting the amount in when we make the offer. So if we were to be looking at a $200,000 house and you were comfortable putting $1,500 down for earnest money, it would just be money that you wouldn't have access to until you closed on the house. Again, typically it's about 1% of the sales price. The more earnest money that you put down, the more competitive your offer is, and the more that the seller knows that you're looking to purchase the house and that you're going to follow through on purchasing the house. So sometimes it's good to put more down. And sometimes, you know, if it's been on the market for a while, it's okay to put less down. Does that answer your question? Awesome. And so the 3 ways that I typically see earnest money going back is, 1, if you choose to remove yourself from the transaction because of the home inspection. The second is that if you were to get the offer accepted and the appraised value comes back lower, which we're going to talk about right here, is then you would also get it back, because if the appraised value comes in lower, there's a contingency clause, which is just saying that in order for the contract to be binding, it has to meet all of these conditions. And if it doesn't hit the appraised value and you can't come up with the extra money, the seller doesn't have a right to the earnest money. And then the third way that I've seen it is just if, you know, you do anything within the first 10 days during the home inspection where you need to remove yourself or you don't get approved for the loan, you can typically get it back too. So if you don't qualify for the loan because of a loss of a job or something like that, you can typically get the earnest money back too at that point. And so the difference between asking listing price and appraised value, right now in the market that we're in, it's been very competitive. It has been getting a little bit less competitive. Last week, there was about 3,000 houses on the MLS for sale in the West Michigan area. As of this morning, there were 4,200. So we have about 1,000 more houses for sale, which is incredible. It's been the first time that it's broken 4,000 houses for sale, and I want to say like 5 months. Rob can attest to it. I'm sure, you know, from the people that we've worked with, typically we're putting in like 3 to 4 offers right now. I listed a house for a past client. We listed it at 175 and the winning offer was $200,000. Somebody offered $25,000 more than the asking price. And it was just because there were so many competing offers on it that's what they wanted. They knew that they wanted that house and they were willing to pay for it. Now, with that being said, the listing price is really just there to give you an idea of what the seller's looking for. Oh, yeah, sorry. Did that answer your question, Olivia? I assumed with the thumbs up that it was good. Okay, great. So typically the asking price or the listing price is just what the seller has it up for sale for. When a real estate agent lists a house, they have to agree on a price to market it with the seller. Right now, I would say things are typically selling at listing price or 10% above listing price. That's just because of the fact that the market's really hot and there's not as much, or there's more buyers than there really are sellers on the market right now. The appraised value is when the appraiser comes through and makes sure that the house is worth what you're paying for it. And you are protected in that way, because if the appraisal comes in low or it's not there, you're not required to buy the house for more than what a professional appraiser is saying that it's worth. And so The difference between a buyer's and a seller's market: in a buyer's market, there's a ton of inventory, there's a surplus of houses, and there's not as many buyers looking to buy houses. More people are holding on to their, or trying to get rid of houses than trying to hold on to them. Typically in a buyer's market, though, the interest rates are much higher. When you hear of a buyer's market, typically it's a buyer's market for cash buyers. If you're working with Rob and trying to get a mortgage, you're going to find that the interest rates are probably going to be higher in a buyer's market. A seller's market is where more people are selling their homes and they're trying to get rid of them. We're in a seller's market right now. And when you're in a seller's market, the seller has a little bit more say on the price and everything. But again, typically you're going to be getting a lower interest rate. Like Rob talked about, his first house was 6%. I know
6.8.
6.8, 7%. I know when my parents bought their first house, they paid, I think it was 12%. This was back in the 80s, of course, when, interest rates were phenomenally high. And Rob, what is it, Rob? Like, I think it's each 1% is like $20,000 or $40,000 of purchasing power. Do you know that stat off the top of your head?
Yeah, 1% right now is about $20,000 in purchasing power.
So
you can buy a lot more house. And our rates as of today, as of yesterday, I was locking in 30-year mortgages under 3%. So
yeah, and I mean, I just refinanced 2 rental properties with Rob because the interest rates are just so low that it makes more sense to buy something or to get something right now, mortgage wise, than to wait and maybe risk it going up to 6 or 7% again, because it's going to be a lot more expensive. We did cover earnest money a little bit earlier. Does anybody have any other questions on earnest money or the difference between a buyer's and a seller's market?
no.
Cool. In closing costs, Rob and I are probably going to talk back and forth on this, but there's typically one big thing from a real estate side, and that's known as an administration or a brokerage, like a buyer brokerage fee. And typically what that's for is when you're a real estate agent, your broker charges you money in order to work for them. I know it doesn't make a ton of sense, but yes, when you work as a real estate agent, your broker charges you money to do stuff for them, and they charge you money to hold everything. And typically they want to make sure that there's a small administration fee associated with each account or each transaction on the buying side, just to hold on to everything and to keep track of all the paperwork, all of the other stuff that goes along with the transaction, to make sure that you're 100% protected. My fee for that is typically $295. I know there's other people around here, around the area, that charge a lot more than that. And there's, I think the average is about $495, but I try to keep it as low as possible. You're going to have prepaid taxes. You're going to have prepaid insurance. And what that means is that when you go to close your loan, you're going to be putting all the money for the taxes into an account, so that way the bank can pay it, so that way you're never behind on taxes or insurance. You're also going to pay some title fees, which is just making sure that the house is clear and equitable. And what that means is just when you go to close on the house, nobody can ever come back and say, hey, I want the house now. My mom actually willed it to me 35 years ago, and I just decided that I wanted to get the house yesterday. The title companies put title insurance on it, and that's one of the fees. On top of that, you're going to have some lending fees, which is just originating the loan, making sure that the underwriters get paid, and you might be paying down certain points. And what that means is sometimes, you're going to be talking with Rob, and Rob's going to say, hey man, if you give me $200 more up front, I can lower your interest rate by like 0.5%. And typically that saves you so much money over the lifetime of the loan that it's worth the $200 up front. But that would just be something that might be included in the closing costs. Are there any other ones that you want to talk about, Rob?
Wow, Zac should probably just switch over to doing mortgages, because he nailed most of that pretty good. Yeah, lender fees. It doesn't matter where you go, a lender's going to charge you money to do a loan, and it's typically in this market between $1,000 and $2,000. Arbor is pretty low. We're at $1,200. And that's just a fee. When it comes to stuff like, and you're going to hear this term thrown out a lot, that's points, and Zac touched on it. What that is you're basically bringing money to the table up front to buy down your interest rate. I don't quote rates with points in them. So whenever I show you a rate, or if we're working together in the future and I give you a rate, that is without points in there. I show you the rate, and then what I will tell you is, hey, if you spend, like he said, $200 to save X amount on your interest rate, I'll tell you. Basically, the way I talk about discount points and that kind of like stuff that's complex, if it's something I would do, I tell you about it. If it's not something I would do, I don't. If it costs you $3,000 to go from 2.75 to 2.625, that doesn't make a ton of sense in my head. So I don't tell you that you could do it.
Unless anybody in here is a secret millionaire and you're buying like a $4 million house. If you are, please put it in the chat. We'd love to hear from you.
Yes.
Yeah,
Yes.
then it might make sense to save the 1.25 for $3,000, but
Yes.
you know, yeah.
We work on Sundays for those people.
Yeah.
We always work on Sunday.
Right.
Anyway, and then, yeah, so there's also the escrow accounts. And this is where like calculating closing costs gets kind of tricky, because this all depends on what time of the year you buy the house, because your summer and tax bills are due at different times of the year. And also right now, and this is just kind of a warning, if you guys are going to go out looking at houses, whatever they're saying the annual tax bill is, the odds are you're going to be buying the house for significantly more than what it was originally purchased for, just because it is kind of a seller's market and because real estate prices have gone up. So you'll want to get with one of us, unless you're a total math nerd, and I can tell you how to do it after the call to calculate what your tax bill would be like after you bought the house. The easiest way to do that, fill out an application and then just shoot me addresses and I can send you back what it would look like. It's pretty straightforward. It doesn't take me that much time, and that'll give you a good idea, because the actual closing cost is about $2,500. But then when we add in stuff like escrows, like I did a house on Beaver Island one year where the property taxes were $12,000 a year. So that kind of changes it. Whereas in, I'm talking from Montego today, property taxes are a lot less than Beaver Island.
Mm-hmm.
Actually had to fly an appraiser for that house. It was a giant pain.
Did you guys have to pay to fly the appraiser?
Yeah.
Wow, cool.
Great.
Must have been nice. Yeah.
All right, so you have an accepted offer. What you want to do is give myself a call. Let me know what's going on. That way I can get ready for it. Zac will be sending over like the purchase agreement, things like that, or your realtor will send them to me. Anything that I haven't collected yet, that's when I'm going to ask you for it. You're going to work with Zac to get the inspections ordered, and then we'll get the appraisal ordered as well. We'd like to do the appraisal after we do the inspection, just so that way you're not paying for something. If at the house inspect poorly, we want you to be able to back out and not spend the money on the appraisal, obviously.
Mm-hmm.
Please don't make any major purchases. I know that you're excited. You bought a house. You can't wait to go over to Art Van, even though it's closed now, but there's some furniture store that you can go to, I'm sure, to buy a bunch of stuff for it. Wait until we're done, please. Because even if it doesn't hurt your ability to buy the house, it's just more documentation that we have to collect. It slows the loan down. Zac gets yelled at by the people selling it. I get yelled at by everybody. And it just, let's get the process over with first, and then feel free. And then also refrain from career changes. That's probably poorly worded. Don't change your career. Just don't. If you have an accepted offer, don't do anything really any different. If there's something that comes up, because life does happen and something's going on, call one of us, we'll walk you through it, because it's probably not something we haven't seen before. And there isn't a whole lot of stuff we can't overcome as long as we know about it.
Mm-hmm.
So we call this like the circle of mortgages or real estate transactions. The first step is you contact your credit union. I get you pre-qualified and approved. Find your realtor, preferably Zac, because he's talking to you today. He's going to give you a book that he wrote, because he's motivated to write books, and start looking at houses with him. Make an offer, get your stuff into me. Then you order that inspection. That's that 10-day window we talked about earlier. From there, we order the title work, the appraisal work. Zac actually described title work really, really well. I always use this example of like, you're not drinking a beer on your porch and some guy walks in your driveway and says, here's my deed, I actually own your house. That's what title is there for, is to protect you. Should that happen, your title company is going to step in and make them go away. I don't know how they do.
And the real estate agent actually orders the title work, so you guys don't need to do that. Just wanted to point that out.
Yes.
Yeah.
Then Then what we do after we get the appraisal in is we'll review the appraisal, make sure the value is there. If we need to adjust the numbers, we do it at that point. And we schedule our closing. The day before, Zach's gonna take you, or the day of, Zach will take you on a final walkthrough. And then we all meet at, you're typically using Nations now, aren't you?
I'm using attorneys most of the time, if possible. But yeah, every title company is about the same. They all charge about the same amount of money. It just depends on who the real estate agent has a good working relationship with. Because typically speaking, if you have a good working relationship with somebody, they'll give you I don't know the best way to, but like special closings where like if you need to have something happen, or say, you know, you're running into an issue where your lease is up and we really tried to close sooner, but now we're kind of cutting it close at the end, they'll make special accommodations just to make sure.
Yeah. Or if you can't if you can't make it into the title company, they'll arrange somebody to drive out to you if we have to do it that way, things like that.
Yeah.
And then that's kind of it. I think we did it in just about 45 minutes. That's not terrible. Any questions, everybody? You can unmute, type stuff in. Somebody's typing. Okay, so the question is, what happens if you're a 1099 employee? Typically, if you're a 1099 employee, then that means that you will be paying your taxes on a Schedule C on your personal income tax return. What I would just need in that situation is your past 2 years of full tax returns showing that Schedule C, as well as any of the 1099s you received. Other than that, we just do a profit and loss, and I can help you. If you've never done a profit and loss, I can help you do one for the year so far, and then that's what we'll need to generate your income in that situation.
I'm a 1099 employee, technically speaking, and I used Rob to do everything, and it's really easy if you have 2 years of history. If you don't have 2 years of history, it's near impossible, is what I would say.
Well, the one thing that we do have right now is because we are a Freddie lender, there are situations where if you've got good credit and the income is there, we can get by with 1 year.
Okay, cool.
So it's just but that's on a case by case basis. Typically, plan on giving me 2 years, and if I don't need it, I will take it away. Did that answer your question, Caitlin and Manny? Perfect.
Cool.
So we're giving away a prize to everybody. No, it will not. It will not actually impact anything. Are you in the same line of work, or is it changed?
And then for the average length of time between someone searching and closing, it really depends. Right now, I'd say budget for 4 months. So if your lease is up in like 5 months, you're good to start looking right now. That's just because typically speaking right now, you're running into issues where the first 2 or 3 houses that you want to buy, there might be 3 or 4 other people that want to buy them. And it's just iffy whether or not you're going to win your first or second offer on a house. And closing on it typically takes about 60 days is what I would say. With most of the loans, I would just plan on 60 days. It's probably going to happen sooner than that. Something Rob and I forgot to mention with the closing cost, though, was that when you do it, and correct me if I'm wrong on this, Rob, but most of the time with the loan, you're going to prepay for a month of interest. So if you were to close in July, you would close in July, you'd prepay for July, and then you'd prepay for August interest. So then you wouldn't technically have a mortgage payment until September, again, typically depending on your loan. So even if your lease is up in 5 months from now, it's usually better to start looking sooner in this market than to wait and try and push it, just so that way you don't feel forced into buying the house that's available, and you can maybe get like a choice between 2 or 3 houses, or put 1 or 2 offers in. Does that kind of answer your question, Jake and Aaron? Cool.
And then and Amy will come right back to you. The one, yeah, he actually said that correctly. You always skip that first month when you buy a house. So if you bought a house in July, your first payment's not going to be till September 1st. Now, if you bought it at the end of July, your closing costs are going to be less because you're not paying interest for all those days in July. Whereas if you bought it on the 1st of July, you're going to have a higher closing costs because you're just paying that daily interest on the house for those 30 days. Now, you buy the house on July 1st, you have basically 2 full months without a payment. You buy it on the 30th, you have a payment in basically 30 days. So that is something to consider. And yes, that is how that works. And then Amy, to answer your question more in depth, if you've changed jobs and you're in the same line of work, there's really going to be no impact. If you're a salary or hourly employee and there's 40 hours a week there or something that we can base it off of, then again, no, not really a main issue. We'll usually want to see you there for 60 days just so you're through any sort of like trial hire period. And then finally, if you're a commission-based person though, and your income is going to fluctuate based on that, then it can become kind of sticky as long if you've changed fields. But hopefully that answers your question. But no, it won't be an automatic issue. As long as you've got 2 years going back, we should be fine.
As far as the married question goes, it depends, and Rob can talk more about this, but it depends on if you guys both want to be on the mortgage. If one of you has a terrible credit score and the other one has a really good credit score, you may not want the second person on the loan. That's typically what I see, is that if somebody has a low credit score, you're going to have the person with a high credit score. Or like if somebody has a ton of student loan debt and the other person doesn't have a ton of student loan debt, you're going to want to have the person that has a better debt to income ratio too. But it's really case by case. And I would just recommend talking with Rob in order to figure out if it's better to have both people or not both people.
Yeah, it's a very situational type of thing. If both people, like if one person's got good credit, one has poor credit, at the end of the day, you don't have to both be on the mortgage. One of you can be on the mortgage and securing the mortgage while both of you sign the deed at closing as well. So it just depends. And also we like to collect as little documentation as possible. So even let's say husband and wife are applying for a loan and the wife is the breadwinner and makes most of the money, and the husband, he's got great credit too, but we don't need his income or anything. I'm not going to request it because if I don't need it to do the loan, I don't want to put it in there. It's just more things for underwriters to have questions on. It's more work for you. So if we don't need it, I don't necessarily want it, if that makes sense. Yes, Zach and I actually just did a piggyback last beginning of the month. We closed it. So at Arbor, we have what's called a piggyback mortgage. It is where you'll say you're buying a house, say the house is worth $100,000. So you don't have 20 grand to put down to make it an 80% loan to value mortgage. And all of our stuff is based on loan to value for mortgage insurance, everything like that. Rates are affected by it. The piggyback mortgage is you've only got 5 grand to put down. So you'll come to me, we'll fill out an application and we'll say, you know what, you don't want to do mortgage insurance, that's fine. What at Arbor we can do is we'll set you up with a mortgage for 80% of the purchase price, so $80,000 on that house. We will then give you a 30-year fixed rate second mortgage for the $15,000 that you don't have the money for, and then you still just bring us that 5. What it does is it lets us avoid mortgage insurance. It's a smaller loan that you can pay off faster. It's also stretched out over 30 years, and the rate is only going to be 1% higher than what your main first mortgage is. And now, so for example, the one that we just did, it was 2.625, I believe, was the primary mortgage. So the secondary one was 3.625. The payments are really low. You can pay it off faster. It won't adjust at all. And in a lot of cases, it saves people money, but we're going with mortgage insurance. So it's actually a fantastic thing that we have. I'm like the guy at Arbor that does the most of them. And I won't typically build them out at the beginning, but once you get under contract, I'll be like, here's what a standard, 95% loan to value with 5% down looks like. And then here's what the piggyback looks like. Which one do you want to do? And normally the piggyback's saving you some money. Did that answer your question? It's a fantastic thing to use. Yeah. It's a lot more paperwork on your end. Like when you sign, you're going to be signing for 2 mortgages. It takes forever, but it's great. I mean,
it wasn't too bad. It only took an extra like 5 minutes.
That's good.
Oh, earlier, is that due to fewer buyers or more sellers, or is that due? So to answer that question, that's a really loaded question. So this might take like 2 or 3 minutes to explain. But newly constructed homes, to start off with, I think that there's some good options for first-time home buyers. But because of the COVID shutdown last year, there was a long gap. I think it was like 3 months where they couldn't construct at all. And then there was also a couple months afterwards where they could only have one crew on the job site at a time due to COVID laws. And so basically, like, if the drywall guys did something, the trim guys couldn't go in right after. They had to wait a full day. So there's a really big discrepancy. There's not enough new construction homes to make up for the inventory that we're lacking in the market. There are more houses on the market this month than last month. I think it's more because there's a slowdown in the number of buyers looking. Now, I'm not saying that you're going to go out there and be able to offer $20,000 less than asking price and get it accepted, but you're not going to run into, I know at the peak of what I'm calling like the craziest market ever, I was up against 48 offers with a buyer on a house, and we did not get it. Somebody offered $50,000 more than the asking price in cash. And these buyers offered $35,000 more. Now, recently, what I've been seeing is there's 2 or 3 offers, or 3 or 4 offers on the house, not 48 offers on the house. And I think that's because a lot of buyers found houses. A lot of buyers probably decided to rent for a year to wait until the market cooled down. And to answer the question about a shift towards a buyer's market, this again is just my opinion on it. You can look at a ton of different opinions on it. Until the interest rates probably hit 5% again, I don't think that it's going to truly be a buyer's market. And I don't think that the housing prices are going to go down. Statistically speaking, over the last 5 recessions in America that date back to 1930, there's been 2 times out of the 5 times where housing prices have gone down during the recession. One was 2008, that went down 20%. The other one was, I believe, 1975, and they went down 1%. Other than that, every single recession or anything like that in American history, the housing prices have actually gone up. So even if it does shift towards a buyer's market, it may just be a higher interest rate and not as much competition. I really don't think that you're going to be saving 50 to 60% on the houses like 2008. And that's really just because there's so much equity in houses right now. So like I was talking about earlier, people that bought houses 5 years ago have so much money. And even if people are behind on payments right now, the banks are still up on the properties because of the other properties around them that are selling for more money. And so it really just won't allow, or it's not looking like it's going to allow for a huge decline in pricing, if that kind of answers all of the questions in there. Justin.
I think you hit it pretty well. The other thing, like he said, there's been a slowdown ever since the 2008 collapse. There's been a slowdown in new builds just in general. People aren't building as many houses. We had COVID that slowed it down. We've had lumber import tariffs that have slowed it down. Then we've had, actual shortages of building supplies. A lot of you are, I'm assuming, renters, since this is a first-time home buyer scenario. Like, how easy is it to go out and find even rentals right now? There's an overall shortage of housing, not just houses, but housing in general in this country. So as buyers, you're going to have a little bit more say, but a return to like a buyer's market where we're offering way less than listing price and market value, I don't see that happening in the short term for sure.
Yeah, I would imagine maybe 5 years out. And to also touch on the new construction, builders do pay real estate agent fees. So if you are thinking of new construction, or you don't want to go into a used home, there are some affordable ones in the 200,000 range where it's about the same as your rent. I've helped quite a few people last year find new construction homes in areas, and they appreciate pretty quick, just because the builders are charging so much more money, and they do pay real estate fees. So, it helps to talk with a real estate